So tonight we're doing chapter 3, which is about the same length in slides as far as we had last week. We're still talking about job costing. So we're going to be talking a little bit about what we did last week, and then we're going to be going over a little bit more on the financial side, what's happening with the cost, how we put it into in the journal entry into the financials, and what does it look like at the end of the period if we have that over unapplied that we talked about. But before we get started, do y'all have any questions from last week or anything on the homework?
I just want to make sure, clarify again. The homework's due tonight at midnight, but if we don't complete it by then, we can still submit it late.
Yes, that's correct.
Okay. I'm going to try to get it done, but I work full time and sometimes
yeah, I know that. Yeah, and you have other, tests and classes, and so sometimes, I mean, I know, when I was back in school, I was working full time. I had 2 kids and I had 5 classes. So anytime I had an online class and it was a little bit flexible, it was helpful because then I could kind of fit it into my schedule. So, so just, if you can't get to it tonight, that's fine. Don't stay up late trying to kill yourself to get it in. You can do it later, but just make sure you spend enough time to understand the information, because some of that's going to be on the test. So you want to try to get all those homeworks done before you go into the test, without having any practice. And a lot of, the questions, they're coming from Connect through the online service. So it has a lot of the same, feel and how the questions are presented. So the homeworks are a little bit more complicated than some of the test questions, just because, for the testing, for time's sake, I can't ask, those long problems like that. But I do want you to be exposed to it and get the experience with it. So right now I'm sharing my screen. Can you tell me what screen you see?
See the windows.
I just see the blue one, yeah.
The blue screen? Okay. So I'm gonna get the PowerPoint open. Let me see where it pops up. Nope, gotta switch it. This one. There we go. Okay, so you see the chapter 3?
Yep.
Okay. All right, so we're going to be going over the job costing and the cost flows and the external reporting. So anytime you have a question, just like any other week, just stop me and let me know. And like I said, I mean, a lot of this is kind of what we went over last week. We're going to kind of review a little bit, and then we'll bring in some of those things we did last week. So hopefully, you have a good understanding of the material as we're going through it, since you kind of got an idea of what, of this information from last week. Okay. So we have 7 important vocabulary terms. They were introduced last week, and one of the things we talked about was job order costing. We talked about what types of companies would use job order costing. So we have companies that sell products, they have jobs, there's services. Remember, we talked about accounting and lawyer firms. They use this type of costing as well. So it's not just people that are in manufacturing. And then we had absorption costing, which was the costing method that included all the manufacturing costs, which is direct materials, direct labor. And then we have that manufacturing overhead. Remember, I said there was 3 things. So inside of that manufacturing overhead, we have variable and we have fixed costs. And we looked at that. So remember those 3, because that's going to help you when you're trying to cost out your job for any of your problems: direct material, direct labor, and then that manufacturing overhead. So it's about the allocation base, a measure of the activity, such as direct labor hours or machine hours. It's what we use to assign the cost. So the problem may say that they are basing it on direct labor hours, or they may say machine hours. And that's probably the 2 you're going to see throughout this semester in this chapter. But they can decide at a manufacturing plant what they feel is best or the most accurate way to come up with an estimate for that predetermined overhead rate. And how they decide what that is just based on the type of work that they do. And so that's your allocation base. And then remember, we talked about the predetermined overhead rate, and we figured out that we had a couple of problems that we went through where we came up with the total estimated cost, and we also came up with the total estimated allocation base for a whole period of time. So maybe the period is 12 months. And we use that in order to determine how much is it, so per machine hour or per labor hour, so we can cost it out on those jobs. So we talked a little bit about that last week. We looked at the formula. We did some calculations. So it's the rate used to charge the manufacturing overhead. It's an estimate that's done ahead of time. We come up with that estimate before the period, and that way we use it throughout the period. And at the end, we're going to compare what actually happened versus what we estimated is basically what this is. And we're going to go through that tonight. We're going to end with looking at that over applied or under applied and how do we handle that. So that we talked about last week, and there's your formula again. So predetermined overhead rate equals the estimated total manufacturing overhead cost. So the total cost, and that's the numerator. It's divided by the estimated total amount of the allocation base. That's your denominator. And then we had overhead application. So the process of assigning that overhead cost to the job. So remember, we came up with that estimated rate, that predetermined rate. So we took that and we times it by, if it was machine hours, because that was our allocation base. If we said this job had 1,000 machine hours, well, that's what we would use to multiply against that estimated rate to come up with what are we charging to this job for overhead. We need to cover those costs that are part of the, let's say if it's a manufacturing plant, part of that facility, the plant needs, electricity, and you have that rent, and you have management that's got to come in and oversee a lot of different jobs. And so those aren't brought in directly to the job. So those are those overhead costs that we're talking about here. It's just the ones that are fixed and variable, but they're not easily traced onto the job. It's not direct materials, not direct labor. And then we have our normal costing. So a costing system in which overhead costs are applied to a job by multiplying a predetermined overhead rate by the actual amount of the allocation base. Job cost sheet. We looked at an example of what that would look like. We also talked a little bit about what would that look like in the real world today using a software accounting system on the computer. And so everything would get entered into there, and then you could run reports based on, what was the estimated versus what was the actual. It could be just from the raw material standpoint, run an inventory list and what, or maybe a pack and slip, what was pulled out that went onto a job. So you have a job cost sheet that we looked at in class that had how many materials it had on it, what was the labor that was on it, what was that manufacturing overhead that was on it. And I was just explaining that, right, now we're not logging that on a sheet. We're actually putting things in the computer and we're running reports that look like that, and we can get that information off of it. So it has the direct material, direct labor, and the manufacturing overhead that's costed to a job. So that was just kind of a recap of the terms, the things we went through last week. So now we want to understand the flow of cost and the job order costing system. So remember, we talked about these different buckets. So you have that inventory and you have your work in process, your finished good you end up with. We're going to walk through that process and what does that look like? How do we do journal entries? How do we record those costs? And then how do we use the T accounts? You should have been exposed to both of these objectives and principles. So you went through journal entries when you had material that you sold or inventory that you were selling. You had entries that you had to do. And hopefully, you went through your T accounts as well, because those can be helpful. Everybody learns different, and sometimes doing those T accounts helps see the flow of what's happening in your accounting system. I still use those today here. Sometimes if I have to look at transactions and trying to figure out what they did, I'll just break it down on T accounts and see where is everything kind of sitting. Look in my trial balance and see what, my balances are, and if I'm following the flow of it correctly. So T accounts are real good for that. All right, so we have our raw material, which is that material that we're pulling that's going to go into producing a product, and it's going to come out on the final end, not usually in the same form. So when we pull that material, we're usually using it in combination with other materials in order to produce an end product. So we have that raw materials. We probably have people that are working in that department that are overseeing that material, that are pulling the materials for the techs, that are doing inventory, making sure that parts that are bad are getting sent back and we're getting credits. They have people that manage all that. So you probably have a whole department just for your raw materials. That is going to come out and can be directly traced very easily to a job. So those raw materials, that's your direct materials that are going to get pulled in. And then you have your work in process. So your work in process is, what are we working on now? It's going to have your units of production that are only partially complete at the end. They stay in work in process. Some things will be in work in process when you enter the month, and some will finish and move out of work in process. So we're going to look at that flow. And then we're going to have the finished goods. So in the end, you come up with a completed unit of a particular product, and that is what we're going to sell either to resellers, or we're going to sell directly into the market to customers. So we'll look at that account. Now, we talked a little bit about this last week, but I want to see if y'all remember. Do you know what kind of account the raw materials, work in process, and finished goods are? They show up on the balance sheet. So what type of account is that? Do you remember? Anybody want to take a guess? Do you want me to give you some accounts and then you guess from that?
Yeah.
Okay, so it's on the balance sheet. So what's on the balance sheet? We have assets, liabilities, and owner's equity. And so if it's something that we can use in the future, it's going to benefit us in the future. So would that be an asset, a liability, or an owner's equity?
Equity.
Not equity.
An asset.
Asset. It's an asset. So we have materials. That's going to be part of what we own, that we're going to be able to use those materials to build a product in the end that we can sell. So it's going to benefit us in the future. Work in process, same thing. We're pulling all those pieces in. We have a product that we're getting ready to bring in. And then we have the finished goods, which are ready for sale. All three of those will be three different accounts, but they're all three assets. Okay, we're going to benefit us in the future. Then we have cost of goods manufactured. So we have, that includes the manufacturing costs associated with the goods that were finished during the period of time, like during a particular period. And we'll look at how to calculate that. We'll have an example for that later. All right, so we have our costs, raw materials, direct labor, manufacturing overhead. That's the three we've been talking about. Those are going to pull in to the balance sheet where we have our raw materials, work in process, and finished goods. Once we have the finished goods and we sell it, then we move it over into, we have what? A sale. So it goes on to the income statement. We're going to have income from that sale, and we're going to have to also relieve that inventory and cost it out at that cost price. So that's going to be our sale less our cost to give us our profit. Okay, that's on the income statement. So right here in the center of this green box, that balance sheet is what we were just talking about. Those three accounts are sitting there that are going to benefit us in the future. And then at the bottom over here, we also have selling and admin. Remember, we talked about those expenses aren't going to be brought in on the job, but they'll be brought in as a period cost. It's not part of that production process. It's going to come through after. We'll have some expenses that go along with trying to get that inventory that we have in finished goods out into the market. Okay, so we have an illustration here of what's happening with the job order costing system. So we have Rugger Corporation's transaction for the month of April. Rugger is a producer of gold and silver commemorative medallions and worked on 2 jobs in April. So job A is a special minting of 1,000 gold medallions commemorating the invention of the motion pictures, and it was started during March and completed in April. As of March 31, job A has been assigned $30,000 in manufacturing costs, which corresponds with Rugger's work in process balance on April 1 of $30,000. And then we have job B. It's an order of 10,000 silver medallions commemorating the fall of the Berlin Wall. It was started in April and was incomplete at the end of the month. Okay, so we have 2 jobs. We're going to look at the flow on the T accounts. So we have our raw materials. This is those materials that we bring in that we're going to use. When we pull direct materials out of that, because this is an asset account, it normally carries a normal debit balance. So when you learned about those asset accounts and principles, you learn that they normally carry a debit balance. So in order for me to reduce that account, when I take that material out, I no longer have it sitting in materials, so I have to reduce it. Well, how do I reduce it? I'm going to do a credit to direct materials. Where am I moving it to? Well, I'm moving it over to work in process onto a job. So it gets pulled out, it gets put into an account called work in process. And a lot of the job cost systems will have some sort of job number that's associated with it. So in the general ledger account, you'll see a bunch of costs that are coming in because you're probably going to have multiple jobs. You'll see them all in there in the work in process account, but they'll all be identified to different jobs. And so each software is different in how they show that. But when it moves into that work in process, it's going to be sitting there as a debit, and it stays in there as a debit until we pull it out of there. Because remember, that's also an asset account. So we're moving it from one asset to another asset. Okay, nothing happens with the income statement because we haven't sold anything yet. And so we don't have any cost of goods sold and we don't have any sales. So all we're doing is just doing a journal entry to credit one asset, debit another asset. Remember, they have to balance. Debits have to equal credits. And, hopefully you remember that from the principles class. And there's some, those slides that are on Moodle if you need to go back and refresh anything with the flow of that or what normal balances are. Those notes could probably help you. And then we have those indirect materials. So again, those are materials that are sitting as a debit because they're inventory, but we're not going to pull them into a work in process under a job number because those are hard to track. They're hard to trace over to a job number. So we're just allocating that overhead cost. In this example, what we're doing tonight is with that predetermined overhead rate. So we're going to take some of those indirect materials, and then that is going to move into your manufacturing overhead as a debit. Okay, so that is your actual. This is the actual cost of those indirect materials going into that overhead. And you also have that applied amount, which is what we are going to be using with the predetermined overhead rate. So you have 2 things happening in the manufacturing overhead. Okay, so we take in putting a credit into materials and a debit into manufacturing overheads for our actuals. All right, so we have purchase of raw materials and a journal entry form. So April 1, Rugger Corporation has 7,000 in raw materials on hand. During the month, the company purchased on account an additional 60,000 in raw materials. So I'm buying something and it's telling me, let's say they purchased on account. So when you see on account, that means that they're not paying cash for it yet. They have an account set up with someone that they buy this material from. And so it goes into an accounts payable instead of a cash account. So raw materials is your debit. That's coming in as an asset, 60,000. And then accounts payable. Do you remember what kind of accounts payable is? Is it an asset, liability, or owner's equity?
Liability.
Yes, it's a liability. So remember, payable, you have to pay out something. So when you see accounts payable, that payable word should make you think of I'm paying out. And so I'm liable to pay. That's your accounts payable. Because it's a liability, its normal balance is a credit. So if I'm doing a normal transaction, it's probably going to be a credit. I would have to be doing something different for it to not be a credit. So during April, materials requisition forms were prepared to authorize withdrawing $52,000 in raw material from the storeroom for use in production. So I'm getting this material, and I'm going to be using it in my work in process, which is my job that's in process now. Okay, then it says the raw materials included 50,000 of direct and 2,000 of indirect. So because they're splitting it out like that, they're identifying which ones are easily traced to the work in process job number and which one is going to be my manufacturing overhead. Because if I can't trace it, then I have to put it in that other account. So we have 2 entries for the debit and then 1 for the credit. I have an entry that's coming out of raw material. All of that equipment, all that material is in that raw materials account. And so it's coming out of that. And in order to reduce the asset, I have to do a credit. But where I put it is 2 different spots, because some of it is getting traced to a job and some of it is not. So we have work in process, which is the account that we're using to track the job and how much is going in. So we have 50,000. And then we have that manufacturing overhead, 2,000, which is a debit. And remember, this is the actual. So whatever's actually happened is getting a debit to that manufacturing overhead account. And then the credit to raw materials. Okay, so now we're going to look at labor. Do y'all have any questions about material before we move on? Does it make sense?
Yes.
Okay. So now we're going to look at labor. Salaries and wages payable. These are your workers. Some people are on salary, some people are on wages. So we have direct labor. Again, those people are working on the job. You can trace it over to the work in process to a job number. So those are going to go to work in process, and then the indirect labor is going to go over to the overhead account. So we're just doing it again. We're going to do a debit to the payable because it's a liability. I have to pay them in the future. So that's my credit. And then I'm moving it over to an asset. Work in process is an asset account, so it's getting a debit. And manufacturing overhead is my asset account. It's going to get that. I'm sorry, I said credit. It's going to be a debit. And then the manufacturing overhead actual is getting that debit as well. Okay, so in April, the employee time tickets, which provide hourly summaries for each of the employees' activities throughout the day, included 60,000 recorded for direct labor and 15,000 in indirect labor. So again, it's telling you which ones are easily traced, which ones are not, which ones are going to work in process, how much of that money is going to indirect labor. So we have the following entry. So we have work in process, that's being traced to a job number, 60,000. And then we have our manufacturing overhead, that's that indirect labor that's not easily traced, 15,000. And then we have to set up our liability because we have to pay them. So we do our salaries and wages payable, 75,000, and it's a credit. All right, and here's my little T account. So it's showing you what is on there, and then it's got a little, what's happening is you have those 2 credits that went to payables for salaries. You have your incoming costs from direct materials and labor on the work in process side. And then on your manufacturing side, you have that indirect materials, indirect labor, and then you have some other overhead that's going in there. Okay, so let's assume that they incurred the following general factory costs during April. So we have utilities of 21,000, we have rent of 16,000, and then we have miscellaneous 3,000. So we're going to add all of that up because that's our cost that's associated with our plant, our manufacturing overhead. And we are not paying it yet. We're paying it on account. So unless it says cash, I wouldn't select cash on any of your journal entries in any of the test questions or anything like that, unless you see specifically that they say they paid cash. Always assume that it's just purchased on credit and it's gonna be paid later. And you're putting it into the system as a payables function where they put into the account, set up the amount, and it sits as an accounts payable until, whoops, sorry, until you, I gotta go back. Until you're ready to pay it. I lost my screen now. There it is. Okay, so the total cost is 40,000. So remember my manufacturing overhead, whatever's actual is going as a debit. So that's 40,000. If I know that I'm gonna be paying these out in the future, then I'm using accounts payable. It's a liability, which is normally a credit balance of 40,000. So if you can understand at least one side of the entry, that can help figure out what the other side is. So if you know that you're paying these out and they're payables, know that it's a liability. Okay, so now we have that manufacturing overhead that's applied. When we're looking at the job and we're saying, okay, we're calculating this based on, let's say it's $4, for this many machine hours, and we know that this job had this many hours, 500 hours. Well, then I'm just going to multiply and come up with a number. So once I know how much it is, I'm going to credit the manufacturing overhead and I'm going to debit the work in process. So the easiest way to remember this is that when you're applying the cost that you've estimated, it has to go in work in process as a debit, okay? Because it has to be part of the total cost of that product. So it's going to go in as a debit, just like the materials and labor are. So we're going to do a credit to manufacturing overhead and a debit to work in process. Now this is our predetermined rate, okay? So we have actual happening in overhead and we also have applied. When it says applied, that is your, that applied amount is what you've estimated with that predetermined overhead rate times whatever allocation base you have. All right, so we're going to assume the predetermined overhead rate is $6 per machine hour. So they telling us it's machine hours, and they're telling us it's $6. Assume that during April, 10,000 machine hours were worked on job A, 5,000 on job B. So remember, we had those two jobs. We've costed the direct materials and direct labor. Now we have to know how much of that is going to be, part of that is going to be the work in process, the manufacturing overhead. All right, so we have 90,000 because they did the computation, the 6 times the $6 per machine hour times 15,000. And then we have the machine hours totaling 90,000. So 6 times 15 to give us our 90. So that's going to be applied to my work in process. Okay, so the following entry for the manufacturing overhead to work in process is we're going to credit the manufacturing overhead. We just looked at this in the T account and debit the work in process for 90,000. So that's going in on the job B. Is that right? Let's see. I mean, it could be job B, it could be job A. Let me just do the calculation real quick. So we have job A has 10,000 times the 6. So for job A, we would have 60,000. And then on job B, we're only going to have 5,000 hours worked. So the 5,000 times the 6, which is my 30,000. So when you add the 2 up, it's 90,000. So they're not showing you in this entry, okay, I have job A for 60 and job B for 30. It's just showing you work in process. So this is similar to what I was saying when you're looking at a general ledger. You have that work in process account. You're going to see all these amounts coming in. It's going to be multiple jobs, but when you have a job order costing system, you'll be able to run reports off that account number and see how much is in each job. So even though they're not breaking it down in this journal entry, it can be done in practice, okay? You're going to have a different job number for each one of those, and you'll be able to drill down into it to see where it is. You'll also just be able to see what was the cost for this month, and it might be, 10, 20 jobs, not just 2. All right, non-manufacturing costs. They're not assigned to individual jobs, rather expensed in the period. So examples of that would be salaries of employees who are in marketing, who are selling. We have commissions that we pay to sales reps. There's administrative costs that are expensed during the period. So administrative costs might be that you have an office where your corporate office maybe is where your accounting folks work. So the accounting people maybe aren't in the plant, they're in a different location. Well, you're gonna have administrative costs that are associated with that office, those employees, those rents and utilities and things like that. And then you also have advertising. You have to advertise sometimes if you want to get the product sold. So you'll have those as well, and it's going to be incurred in that period. So we're going to look at the journal entries for that. So we have 30,000 in selling and admin salary costs during April, and the following and summarizes the accrual of those salaries. So we talked a little bit about what accruals are, and all that means is that I have an expense and I haven't paid it out yet. I haven't gotten an invoice for it. I need to accrue it. So I know that I have people during the month that have worked on worked, and I have a particular time period that I have to pay them for. So I'm going to set up an entry, a journal entry, to expense it in the period that it actually happened. So in this example, I have 30,000 in salaries expense. So I'm expensing it in that period, haven't paid it out yet. So I have a liability. I'm going to be liable to pay it in the future. So I have set salaries and wages payable, 30,000 as my credit. Then we have this depreciation on office equipment. During April, that was 7,000. So this could maybe be a copier or something like that. It could be a big phone system that you bought. It's some equipment that we're using in the office, and that is 7,000. So we'll have the cost of that depending on the method that you use. Remember, we talked about different methods, and we're only going to stick with straight line in this class, but you have different methods that you can use for each depreciation as well. So we have depreciation expense as a debit for 7,000, and then we're offsetting it in that contra asset account, which is an accumulated depreciation account. That's 7,000, and that is going to offset the equipment that's sitting on your balance sheet, your asset account. This is going to sit to reduce it. Okay, as you go in time, that asset's going to lose value. And then we have the advertising of 42,000. We have selling and admin expenses. In April, that totaled 8,000. So we have advertising expense. We've done a debit for 42,000. Selling and admin expense, debit for 8,000. And then we'll have accounts payable for 50,000. So they're not saying they pay cash for anything. So we're just going to assume we're going to pay it in the future. The note down here says accounts such as cash can be credited. That's because if it tells you that you paid cash right away, then that's what you would use. You would use the cash instead of accounts payable. All right, so do y'all have any questions about any of that so far?
Nope.
Okay, good. So we talked about, pulling that direct material, having some direct labor, costing out some of that overhead, going into the work in process. It's in that work in process until it's finished. At the end of a period, sometimes we have costs or expenses that come through for the period, and we have to enter those like we just went over. It's not going to the work in process system. It's not going to overhead. It's something that we're just expensing in the period. So we just went through all of that. Now we're going to look at what happens when we pull it from work in process over to a finished good. So when we finish it, that's called cost of goods manufactured. So now we have another term that you have to learn because we didn't use this in principles. We didn't talk about it last week. So cost of goods manufactured just is that. It's the cost of what it was to manufacture this finished good. That is the total cost for that job that's coming out of work in process, and it's moving over into the finished good. So I'm taking it out of one asset, putting in another asset. I'm reducing work in process, so I have to credit work in process. I'm adding it to finished goods, so it's going to get a debit. And it sits there until I sell it. and it's the total cost. So it's everything that went into it. It's the direct materials, the direct labor, and the manufacturing overhead. All of that is lumped on. So think about your cost sheet that we looked at last week. It has all three of those sections filled out, and we get a total cost at the bottom. That's what's getting moved over to finished goods. So we have job A was complete during April, job B is incomplete at the end of the month. So the following entry transfers the cost of job A from work in process to finished goods. So if I have something that finished, in this case, it's 158,000. That was the total cost of that job. I'm going to move it out to finished goods. So finished goods debit 158, and then work in process gets a credit for 158. And because job B is not completed at the end of the month, then it remains in work in process and it carries over into the next month. Okay, the balance sheet were prepared at the end of April. The cost accumulated thus far for job B would be 72,000. So if it's just that one job, when you look at the work in process account, it'll say 72,000. If you just have the one job A that went into finished goods, you'll have finished goods sitting there with a balance of 158,000. All right, so what happens when we sell it? Now that we've put our costs into that finished good, we have a product that we can sell. We go out, we market it, and now we sold it. So what happens? I got to take it out of the finished goods. I got to remove it from there because now I no longer have that product to sell. I got to reduce it. How do I reduce an asset? I do a credit. Where is it going? Well, now it becomes cost of goods sold. So that's exactly what it is. It's a cost of some product that I just sold. So that goes in as a debit. And what happens is that's the offset to my income. So hopefully your selling price is higher than what this cost of goods sold is. So all I'm doing is taking it out of my finished goods bucket and I'm moving it over into my cost of goods sold. Cost of goods sold is going to show up on what statement? Do you think it's still on the balance sheet or do you think that moves to the income statement?
Income statement.
Income statement. Yep, because you're gonna have your sales, your income, you'll have your cost of goods sold, and you'll also have your expenses and the net, and then you'll have your net income at the bottom. All right, so we have we're gonna assume that we have a sale. So we have 750 of the 1,000 medallions in job A. They were shipped to a customer at the end of the month, and the revenue was 225,000. Because 1,000 units were produced and the total job cost was 158,000, now we have to figure out how much was it per unit. So you would just divide to come up with your price. So that's how they came up with the unit price of 158. So I take the 158,000 divided by the 1,000 units because that's how many I produced in that batch. So I come up with 158. Remember, we also looked at that last week on the job cost sheet. It showed you at the bottom that you can calculate it per unit. So you know, okay, this is what I'm going to use when I sell it, because you might not sell the whole batch in one sale. In this particular case, that's what happened. You have 750 that were sold, not the 1,000. So we have to break it down to the per unit so we can figure out what was the sale. So when we sell the product, we're selling it for 225,000. They're not telling us that we collected cash yet. So if we haven't collected the cash yet, it's something that we're going to receive in the future. So that account's called accounts receivable. Remember, the accounts receivable means we're going to receive money in the future. That's going to benefit me in the future. So that's an asset account. Asset accounts get a normal debit balance. So what do I do with my journal entry? I'm going to set the receivable up as a debit. So for the total sale amount. So my accounts receivable is what I expect to collect, and that is going to be the sales price. So don't get confused with the numbers when you're trying to figure out what number goes in which part. So when you sell a product, you have two parts to it. That's why you see these two different journal entries, two different, one's for the sale, one's for the cost. So the sale price goes to the receivable because that's what I'm expecting to receive from my customer, the 225,000. So I debit that and then I credit my sales for 225. So remember, we had a debit to cost and that was 158, and we had a credit to sales, The difference between the two is the profit. So we have cost of goods sold, 118,005. And then we have finished goods, 118,500. Okay, so we had $158 per unit times 750. I'm just checking the numbers right now. Times that 750. Remember, we had to break it out per unit. The 158 per unit, and we sold 750. So we're just multiplying. That's where the 118.5 came from. Okay, that's my cost for the ones that I sold. I'm not looking at the cost for the entire production of the 1,000. All right, so now we're going to prepare the schedules for the manufactured and the cost of goods sold and income. Okay, so my schedules are going to contain those three costs that we've been talking about: direct materials, direct labor, manufacturing overhead. And what do the schedules calculate? They're going to calculate the raw material and direct labor used in the production and the amount of manufacturing overhead that was applied to the production. Remember, the applied is your estimate. Applied is the estimate, which is a predetermined overhead rate that we're using. We're taking that rate and multiplying it by the allocation of whatever base we use, which was either machine hours or whatever. So that's your applied. And then the manufacturing cost associated with the goods that were finished during the period. So that's what we're doing with our manufacturing. Production is what we remember on the slide when it comes out of work in process with all those three parts. It's called cost of goods manufactured, and it moves over into the finished goods section. That's what it's talking about. All right, so we have raw materials purchased, purchases made during the period. They're added to the materials inventory. And then we have the ending raw materials inventory. And that goes into, it's deducted from what's going over into the raw materials that were used in the production and the manufacturing of a product. And it's got a little table here that could help you follow suit with this. Like I have a little cheat sheet on how to do it. And we're going to walk through an example that's going to help with this too. So as items are removed from the raw material inventory, they're placed into the production process, and they're called direct materials. So remember that raw material section, we have a bunch of inventory over there that we're going to be pulling out. And we need to be able to know, how do we calculate that? What was it in the beginning? What was purchased? What was used? What's my ending inventory? There's lots of different questions that you can get asked with this. So you need to know how to calculate it. So you have your beginning raw materials inventory. So this is what I'm starting with. And then I'm adding whatever I purchased. So that makes sense, right? If you got a bunch of stuff in your closet, let's say you have a bunch of shoes in your closet. If you buy more, what happens? You have to add them to the closet. So you're adding them to the number that you already have. So I'm adding those purchases to come up with, okay, what do I have available? Now I have all of these shoes that are available, and I can get rid of some, or, you know, whatever. So if it helps to think about it like that in terms of something personal, this might help you understand it. So if you have some products and you buy them more, you're adding to, that's what you have available. Well, what happens during the production of this process that we're pulling out? We're reducing it, right? We're taking it out and we're using it in the manufacturing process. So we're going to have to reduce it by that amount, but maybe we don't know what that was because they didn't tell us. They only gave us what we had in the ending inventory. So they'll give you your beginning, they'll give you your raw materials that you purchased, but then they only tell you what the ending was. So I have to know how to get to that point. Well, I'll just deduct out. So whatever I had available, I deduct out what I used to get ending inventory. Or if I don't have that, I can just deduct out what my ending inventory is to come up with what was used in the production. Okay, you see how we can back into that? And then what happens is that total that was used in the production, that's what gets moved over into the manufacturing costs. Okay. It's eventually going to land in that work in process. So the manufacturing cost has direct materials. What else are we adding to that? We have that labor that we're adding to it. And we also calculating that manufacturing overhead. And that gives me my total manufacturing costs. the total manufacturing cost is going where? It's going into my work in process. So this is just kind of breaking it out a little bit further, pulling it out of raw materials. We're putting it in work in process. We have direct labor that we're costing out, putting in that work in process because it's getting added to the job. And then we have that manufacturing overhead that we're applying. It's our estimate that we're using for that job. That's going into work in process. So all three of those things are getting added to work in process. And then the total, so we have the total manufacturing cost that gets moved over. So we have the beginning, what was in work in process in the beginning, what was manufactured during the month, and that's going to give me the total work that's in process for the period. Okay, we have a beginning balance, and then we're adding in all these costs for the ones that we're working on. So what happens with the work in process? We do finish some. You're probably going to finish some every month. And so what happens is we pull those goods out and they go over into that cost of goods manufactured. It's going to go into the finished goods. So we need to know how to figure it out. Well, it's the same process. We look at the beginning balance. We add in those manufacturing costs that were added to it. And that gives us that total process for the period. And then what do I have left in the end? I can take that out. Or what did I pull out during the process? What were the costs that were manufactured? I can come up with an ending balance. So in this case, it's showing you they gave you the ending balance. And so you're coming up with the cost of goods manufactured was. And your finished goods, the same thing happens. So we have the beginning inventory. We're adding in those cost of goods manufactured. It's coming out of work in process as a whole product going into finished goods. And then that becomes what's available for sale. And then we can deduct out the ending balance to get the cost of goods sold, or they can say, okay, you sold this much during the period, what's your ending inventory? And you can take what's available, subtract out the cost of goods sold, and you get your ending inventory. So it's when you're trying to figure out what's happening in either one of those accounts, you're basically doing the same thing. You have your beginning and materials, you're adding what's purchased, and work in process, you're adding what are those material manufacturing costs that are getting added to it. And finished goods, you have your beginning and you're adding in that material that, you know, that product that's coming out of work in process into the finished goods. So we're taking the beginning and we're adding in something. And then we're deducting the ending balances in order to figure out what was used for manufacturing, what was sold during that period of time. Okay. So it's the same process for figuring it out. So we're going to walk through an example. All right. So we have beginning inventory of 32,000. We have 276 that, that we purchased. So we have the beginning inventory, 32,000. Then we have purchases. And what are we doing? Are we adding or subtracting? Are we adding the material that we purchased to what we had already, or are we subtracting it?
We're adding it.
You're adding it. That's right. So we're going to take the beginning inventory plus the purchases to come up with what we had in there that's available to use in the production. So some of this 308,000 we're going to pull out and use in production. Well, it's given me that 28,000 of raw material was still present. What does that mean? That means that that's what I have left in materials after the month is over. So I need to deduct what's left. Okay. So if I take the 308 less the 28,000, what does that give me? So that 280,000 is what I pulled out of my direct material and moved over into work in process. Does that make sense? I'm looking at materials. I'm going to say, what did I have? What did I buy? So I'm adding it to it. This is what's available for me to use. And I have this left in the end. And so the difference is what I pulled out to bring into my work in process. So it should be C. Let's hope I'm right. Come on. There we go. So it's C, and it's telling you how you calculate it. It's clear. Okay, so it just walks through the same process that we just did. All right, so we have direct materials used in production totaled the 280,000. So now it's telling me that I have, let me write it down, direct materials, 280,000. We have direct labor, 375. And it's telling me how much I have in that manufacturing overhead, which is 180,000. So it says, what are total manufacturing costs incurred during the month? So what do you think we're doing? Are we going to add these things together? Are we subtracting something out? What do you think?
You're adding them all together.
We're going to add them all together. So it should be 835 if you add them all together. So hopefully I calculated that right. 835, there you go. So those are our three costs, and that's our manufacturing costs that we incurred for the month. Okay, that's all those three things that are going into that work in process. Remember, we had all of that going in there, and that's my cost that I had. All right, then I have beginning work in process. That was 125. So now I'm looking at my work in process account. All right, so what was my beginning balance? It was 125,000. So the manufacturing costs that are coming in to work in process, it's telling me is 835,000. So do I add that or subtract it?
You add it.
Yep, we're gonna add those together. And then what do I have in the end? It says there were 200,000 of partially finished goods remaining in work in process. So that means that's my ending balance. So I need to deduct out the ending balance. So this is what I had. This is what comes in. This is what's going out. I mean, staying in, sorry. This is what's going out right here. This balance here. So if I take 125 plus the 835 and I deduct the 200,000, I should come up with 760. See. Okay. 760 gives you your little process that we just did. Okay, so now we're looking at finished goods. So we're moving on to finished goods, and we have inventory, beginning inventory, that's 130,000. The cost of goods manufactured for the month are 760,000. So this is what's coming in, those costs of goods manufactured. And at the ending finished goods inventory, we have 150. So again, it's the ending. So we're going to take the beginning inventory and we are adding the cost in, and then we are removing that ending balance of 150 to come up with the balance of the cost of goods that were sold. So we add the 130 plus the 760, and then we deduct out the 150. And that should give us 740. B. Okay, so does that make sense now that you walk through an example of what we were talking about, how you take that beginning, you add it in, and then you have that ending balance you deduct out. Does that make sense?
Yes.
Okay, does anybody have any questions so far? We're doing good. So we're still, I mean, are you understanding what's happening?
Yes.
Okay, good. All right, so remember we talked about over and under applied. This is looking at that actual cost versus what did we come up with as that estimated predetermined rate. And we're going to compare the two and look to see, did we over apply or did we under apply? So we're going to talk a little bit about this. And I think this is the last part. Let's see. I think this is the last thing to go over. Yeah. Okay. Okay, so it says the difference between the overhead costs applied to the work in process and the actual overhead costs of the period is referred to as over and under applied. So remember on that T account, when we were looking at the manufacturing overhead, we had actual on the left and we had the applied on the right. We had a debit and a credit happening in that account. So at the end, we're going to have some kind of balance. You're never going to have zero. You're not always going to estimate, your predetermined overhead rate to be accurate and you end in zero. It's just not going to happen. So it's either going to be over or under that, when you're using that just means how much am I applying to the jobs? I'm applying what I estimated. So in the end, I got to look at it and say, okay, was it too high or was it too low? So under applied overhead exists when the amount of overhead applied to the jobs during the period using the predetermined overhead rate is less than the total amount of overhead actually incurred. So under applied means that the over applied is less than what was the actual. I didn't put enough. And then the over applied exists when the amount of the overhead applied to the jobs during the period using that predetermined overhead rate is greater than the total of the overhead actually incurred. So the actual is less than what that applied amount was, and that means that I've now over applied too much to the job. So remember, the estimate's what's going into the job. So if I estimate a little high, then I'm over. If I estimate a little low, then I'm going to be under. All right, so Paraco's actual overhead for the year was $650, with a total of 170,000 direct labor hours worked on jobs. And then we have Paraco's predetermined overhead rate at $4 per direct labor hour. So it's telling me how many direct labor hours I have because that's my allocation base we're going to use. So we're going to take that $4 and multiply it by the 170 to come up with the estimated applied amount to the jobs. And we come up with 680,000. So the applied is 680. My actual is 650. So are we over or under applying? Think about that screen that we just, yeah, so we're over applying. We have too much. So Paraco has over applied overhead for the year at 30,000. So what do we do with that 30,000, right? So when we look at the manufacturing overhead, the difference is 30,000. I have more in there than I need. I over applied it. So we have to fix that. So we're going to walk through an example to see how we do that. So we had, and there's a couple of different ways we're going to walk through it. So we had Tiger Inc. had actual manufacturing overhead costs of $1,210,000 and a predetermined overhead rate of $4 per machine hour, 290,000 hours. So we have to take that 290,000 hours, multiply it by the 4. So we have 1,160,000. So this is my actual. This is my estimate. That's my applied. And then what's the difference between the two? So 50,000. So am I over or under?
Under.
So I'm under. So I'm applying 1,160,000, which is less than what my actual was. So I didn't put enough there. So I'm under. So it's going to be B. All right. So any remaining balance in the manufacturing's overhead, like the 30,000 of over applied overhead, it's disposed in one of two ways. So we can go and just take the whole amount and put it in cost of goods sold, or we can apply it to the three different accounts, the work in process, the finished goods, and the cost of goods sold. That would require us to do an allocation. So we're going to walk through an example of both of how we would do the journal entry. All right, so the 30,000 of over applied is going to go into the cost of goods sold. So if we over applied, that means we put too much in the estimate. The actual was lower, right? Over applied, the estimate was more than what the actual was. So we have to move that out of there. So we have a credit balance in that overhead account because the applied is on the left, which represents the credits. So how do I get that out of there? I have to bring it to zero. Well, I have to do a debit in order to make it zero. So I'm going to debit the 30,000 and I'm going to move it into cost of goods sold. So because I put too much cost in through my estimate, now I have to reduce my cost down when my cost is normally what? A debit balance. So in order to reduce it, I got to do the opposite, which is credit. So either way, either side that you can look at to try to understand to help know how to do this entry, learn one side so you know how to get the other side. So the cost of goods sold is going to get a credit of 30,000. So that's how we fix it. So now my overhead has my actuals, has my estimated that I've been applying to the jobs. I at the end of the period will look at that. I'll have to say, okay, well, what am I going to do with that difference? I'm going to clear the difference out. And I have two different ways I can do it. One is this, putting it directly to cost of goods sold. The other, remember, is splitting it between work in process, finished goods, and cost of goods sold. So we're going to allocate it. So they're telling us what the balances are. So we have an ending work in process of 68,000. We have that ending finished goods inventory at 204,000. And then we have that ending cost of goods sold at 408,000. So if we add all three of those up, it's 680,000. So we want to allocate that, which basically just means that I'm going to figure out what percentage of my total, that 680, is in each one of those accounts. And that's what I'm going to use, that percentage, in order to calculate how much is going to go in each one. Okay, so it's not hard. It's just a little bit of work to figure it out. So here's the math, how to do it. So we have the three different accounts with their balances. We divide it by the 680 because that's the total of all three to come up with that allocation percentage. So it's 30,000, right? So for ending work in process, all we're going to do is take that $30,000 balance and times it by the 10% in order to figure out what's going over here into my work in process. Then we do the same for the others. So here's a little table to show you how to do that. So here's my balances. Here's the allocation that I just figured out, which is the 10%, the 30%, and then the 60%. Comes up with 100%. So the whole 100% of the 30,000 is getting allocated between these three accounts. And this is how much it is per account. So 3,000, 9,000, and 18,000. So when I do my journal entry to clear out my manufacturing overhead, that entry part is the same. The difference is I'm not crediting cost of goods sold. I'm crediting three different accounts for these totals here. Okay. So we have our manufacturing overhead as a debit to make it zero. And then we're bringing in the credit over to work in process for 3,000, finished goods for 9,000, and cost of goods sold for 18,000. Okay, so we're just taking the total, what's in those accounts, and then dividing it to get these percentages. And then we're multiplying it by the 30,000 to allocate the full amount to those three accounts. So instead of doing the credit to cost of goods sold, it's going to all three different accounts. Does that make sense?
Yes, this is just an alternative way of.
Yep. You can do either or. So you may have a problem that asks you to do it this way, and then you can have a problem that says they handle the over under applied going to cost of goods sold. So when you do your journal entry, you wouldn't do this method. Obviously, you would just go right into cost of goods sold. Depending on, it would be a credit or a debit, depending if it's over or under applied. In this example that we had the applied was more than the actual. So we over applied. So we had to do a debit to manufacturing overhead. So this is just explaining again that there's the two methods to use to dispose of that balance that's sitting in that overhead account. And it says if you close it out to cost of goods sold, or you can allocate it between the three. And it's saying the latter method is considered more accurate because, you're obviously taking that amount, kind of divvying it up between all of those accounts. Not everything that caused that over or under applied is finished and in cost of goods sold. You didn't sell all of that. So some of it you sold, some of it you finished and it's sitting in finished good, and some of it is still sitting in work in process. So it's just saying that it's a more accurate way to calculate where that difference should go. It should get allocated between the three accounts, not just shoved in the cost of goods sold, because it can maybe, throw off your income statement a little bit. All right, so what effect will the over applied overhead have on net operating income? So remember, you're over applying. If you don't fix it, what does that mean? I over applied, so I put too much in my cost. So what effect will the over applied overhead have on the net operating income? So if I fix it, what's going to happen? Is my net income going up, down, or is it unaffected? We know it's not unaffected because we're doing something with it. So it's over applied. So if I over apply something, that means I have too much in my cost. So my cost of goods sold has more in there than it needed, right? So if I don't fix this, and I still have it as over applied, is that causing my income to go up or to go down?
Decrease.
It's going to decrease because this is higher, right?
Yeah.
If I do something about it, if I have my cost of goods sold, I have too much in there that I've over applied. So now I'm going to fix it and I'm reducing my cost of goods sold. What happens to my income? Is it going up or going down if I'm reducing cost of goods sold?
Your income will increase.
Your income's going to increase. So it's a little bit confusing because it just says what's the effect of the over applied overhead, and it doesn't say that you've actually fixed it or not fixed it. That's why I kind of wanted to walk through both cases. What happens if you fix it and what happens if you don't fix it, to see if you could, understand what's going on. So so that was everything for chapter 3. Do y'all have any questions that you need to ask?
How many chapters are on this next test?
4. And they kind of go hand in hand. We'll kind of switch a little bit in 5. So let me make sure that that's how I have the schedule, but I'm almost positive I have the first 4 chapters together on the schedule. Let's see, follow schedule. Yep, 1 through 4. It's on the week beginning October 3rd. So probably open up around the 6th. So we have chapter 4 next week, and then that following week will be the exam, and we won't meet that week. We'll just have the test online. Chapter 4, let me look at, I'm sorry, not chapter 4, chapter 3. Oops, I got kicked out. See if I can get in real quick. I'm gonna see what the homework looks like. Sometimes it's hard to find my mouse. I have 3 screens that I use, so sometimes I can't find where the mouse goes. All right, chapter 3. pull this over here. So you have 11 questions in there. And some, you know, just might be a real simple question, you know, just thinking through things and answering. And then you're going to have some that you're actually working the problems that'll have multiple steps. You'll have some journal entries to do. And like I said, there's going to be, you know, a lot more work that you'll have to do on the homework than you'll ever have to do on a test. But I'll do the study guide again, you know, so you know like what to focus on. And if you understand the homework, you should do fine on the test. Sometimes, you know, when things are a little bit more simplified, we tend to overcomplicate. So you want to try not to do that. But this homework is going to give you some examples on how to do the journal entries, what's happening in the accounts, what does it look like, you know, if you have to do a schedule of what costs were manufactured. So it's adding in your raw materials and things like that. And then looking at a cost of goods sold, trying to figure out, like we did through the examples, like what is that beginning balance of your finished goods? What's, you know, what was added to it? What's available? What was less in the ending inventory to figure out what was moved into cost of goods sold, like walking through how to do that. So some of the problems may take a little bit of time is what I'm telling you. So so give yourself a little bit of time when you do the homeworks, you know, try to make sure you get them done before you do the test. Obviously, it's going to be better to have exposure to all of these problems prior to the test. You know, you can go back and listen to the lecture. You can do the study guide, but it's always better to have those homeworks done before you do a test. So this will be posted on YouTube. I'll try to get it up, you know, tomorrow at some point, so it's there, and you can use it. And you know, again, if you have any questions, make sure you text me. If you have something that you need an answer to right away, or if you email me and I hadn't responded, make sure you text me.
Okay.
But
When will we get the study guide? Or yeah, the study guide.
yeah, the study guide will come next week, at the end of next week. I'll go through the tests and look at the questions that I'm gonna select and try to give some examples and information on where you need to go to study. So you'll have it for next weekend. That way you have a whole weekend and then a few days before the test.
Okay, awesome.
Okay, so no questions, that's it.
Thank you.
Good
All right,
night.
thank
you. Have a
you.
good
Y'all
weekend.
have a good, yeah, y'all have a good weekend.